Trading futures and options involves significant risk and is not suitable for all investors. You should consult with your financial advisor to determine if such trading is appropriate for your financial situation and experience. ITG Capital Management LLC and its affiliates make no guarantees of performance, accuracy, or profit from the use of any trading system, signal, or algorithm, including ITG Quantum AI or any educational strategy. Welcome back to ITG Capital Management Educational Series on Managed Futures. When it comes to finding a commodity trading advisor or CTA, many investors will work with an investment consultant to match their portfolio needs with an appropriate manager. Finding out about a CTA's returns, risk levels, fees, and investment strategy are all part of an investor's due diligence. Let's take a closer look at how to evaluate a CTA and their managed futures programs. Many investors tend to look at investment returns only. Obtaining the greatest return possible is important to everyone. However, all investors need to review the risks taken to generate those returns. Let's compare two CTAs, CTA A and CTA B. CTA A generated consistent profits between 12% and 14% over 4 years. CTA B has had a few years of stellar returns, but also had some large negative returns. Both CTA investments ended with nearly identical sums, but CTA B did so with measurably greater volatility. The portfolio demonstrated substantial swings up and down. He took greater risk without generating greater returns for his investors. While some investors appreciate the wild ride in search of returns, others wish to reduce volatility in their investments. Investors should be aware of the risk involved in their investments and the potential this risk has on their returns. The Sharpe ratio is a measure for calculating risk-adjusted returns and has become the industry standard for such calculations. The Sharpe ratio is the average return earned per unit of volatility or total risk. Volatility is generally measured using standard deviation. Using our previous example, CTAB would have a lower Sharpe ratio because of the large volatility, yet identical returns. The greater the Sharpe ratio, the greater the risk-adjusted return. Investors would like to see this number as high as possible. Generally, a Sharpe ratio of 1.0 or greater is considered good and implies that for every unit of risk you are assuming, you are achieving an equal amount of return. Negative Sharpe ratios are also possible. Another item investors review related to CTAs are drawdowns. Drawdowns are the peak to valid performance of a managed futures account. Most CTAs report their performance numbers monthly, allowing investors to see the largest losses or drawdowns in any given month. It's also important to review the amount of time needed to recover from a drawdown. Small and frequent drawdowns with quick recovery times are preferred by investors. A general rule is to have drawdowns representing no more than 50% of the CTA's annualized returns. So if a CTA obtains 20% annualized returns over time, you'd want to see no more than a 10% drawdown in any given month. Looking at our previous example, one can see a comparison of returns and risks, shown here as standard deviation, Sharpe ratios, and drawdowns. Both CTAs have 10-year returns that are very similar, but the risk of CTA2 is substantially higher than CTA1. CTA2 took 2.5 times the risk, but achieved a mere 37 more basis points of return than CTA1. Investors with CTA2 were not compensated with higher returns. Therefore, the Sharpe ratio for CTA2 is much lower than CTA1. Consistent with higher risk are higher drawdowns. CTA2's drawdowns are more than twice CTA1's and are greater than 50% of the annualized returns. As previously mentioned, investors need to look well beyond returns when evaluating their investments and choosing a commodity trading advisor. Risk, Sharpe ratio, and drawdowns are a few of the factors to review when selecting a CTA for your managed futures investments.